Wait, are you seriously ignoring one of Singapore's strongest dividend REITs right before the Fed might cut rates? CapitaLand Ascendas REIT just dropped its latest financials, and this could be the moment smart income investors have been waiting for. If you're a Singaporean who loves passive income, stable dividends, and REITs that quietly make you money while you makan, hit that like button so more Singaporeans can discover this video. Subscribe to Wealth for You and stay till the end because I'll reveal whether Ascendas REIT is undervalued and if now's the time to buy. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research or speak to a licensed advisor before investing. Chapter 1. What are REITs anyway? Before we dive into Ascendas REIT, let's clear up the basics. What in the world is a REIT? REIT stands for Real Estate Investment Trust. Think of it like this. Instead of buying a whole condo or warehouse yourself, you pool your money with thousands of other investors to collectively own income-generating properties, like offices, logistics hubs, data centers, even business parks. And the best part? These properties generate rental income, and that income is paid out to you in the form of dividends. It's like being a landlord, but without fixing leaky taps, chasing late rent, or dealing with crazy tenants. REITs are listed on the SGX, so you can buy and sell them just like stocks. And if you pick the right ones, you could be getting regular dividends, 2 to 4 times a year, while your capital grows over time. Chapter 2. Meet CapitaLand Ascendas REIT. Let me tell you about one of Singapore's REIT legends, CapitaLand Ascendas REIT, or A17U SI, if you're the stock code type. This REIT isn't new to the game. It launched all the way back in 2002, back when people were still using Nokia phones and Orkut was a thing. That's over 2 decades of steady real estate income, long before TikTok dances or food deliveries from Grab entered our lives. So what makes Ascendas REIT special? Well, it's massive. Today, it owns a whopping 229 properties spread across 4 regions, right here in Singapore, which still makes up the lion's share, 65% of its portfolio. Australia for that logistics and industrial growth story. United States, targeting modern business parks and warehouses, and UK and Europe, especially in logistics and data centers. And all that property? It's worth a cool 16.9 billion Singapore dollars. That's billion with a B. But they're not just buying any old shophouse. Ascendas focuses on what I call the real estate of the future business parks, where corporates get their work done, logistics warehouses, the unsung heroes of e-commerce, industrial facilities, the solid backbone of the supply chain, and yes, data centers, where your TikToks, photos, and cat videos live. This mix gives them steady rental income from solid tenants. Think MNCs, e-commerce giants, even tech firms. Chapter 3. Occupancy and Rental Trends. Okay, let's get to the real question on every income investor's mind. Are these buildings pulling their weight and making money? The short answer? Yes, but with some small bumps. As of the latest update, Ascendas REIT's portfolio occupancy stands at 91.5%. That means more than 9 out of 10 square meters are earning rent. Solid, right? There was a small dip from the previous quarter, mainly due to a few vacant properties in Australia and the US. Think of them as units waiting for new tenants to move in. But here comes the exciting bit. Rental reversion is up 11%. What's that? It means that when leases expire and tenants renew, they're agreeing to pay more rent than before. So instead of cutting rates to keep tenants, Ascendas REIT is increasing them and still keeping those spaces filled. That's the dream for REIT investors. Properties stay rented, rent goes up. You, the unit holder, get higher or more stable distributions. So while a couple of buildings are temporarily empty, overall the REIT is still collecting strong growing rental income. Chapter 4. Financials Q1 2025 ending 31st March. All right, now let's talk numbers. But don't worry, no need to bring out your calculator. I'll keep it simple and painless. So, in the first quarter of 2025, Ascendas REIT pulled in about 376.6 million Singapore dollars in gross revenue. That's the total rent and related income from all their properties. After expenses like property maintenance and taxes, net property income came in at $260.7 million. And the amount available for distribution to unit holders? A solid $167.2 million. Now here's the part every income investor loves to hear. The DPU, or distribution per unit, was 3.76 cents this quarter. Multiply that by 4 quarters, and you're looking at about 15.2 cents per year, which is almost the same as what we got in financial year 2024. So, is it exciting? Maybe not. But is it stable and reliable? 100% yes. In the REIT world, that's like finding chicken rice that hasn't raised prices in 3 years. Rare, but definitely appreciated. Chapter 5. Is Ascendas REIT fairly priced? All right, we've seen what Ascendas REIT owns and how much rent it's collecting. Now let's zoom in on the numbers that tell us whether this REIT is a good deal, or maybe just a little pricey at the Kopi stall. Here's where things stand as of now. The market cap is around 12.5 billion Singapore dollars. That's how much the whole REIT is worth if you bought every single unit. Its price-to-earnings ratio is roughly 16 times, which is actually pretty fair for a stable income-generating REIT. The price-to-book ratio is about 1.21 times. That's slightly above the historical average, so while it's not dirt cheap, it's not overpriced either. Let's call it slightly premium. The leverage ratio, or basically how much debt it has, is 38.9%, well below MAS's cap of 50%. So, they've still got room to borrow for new acquisitions if they want to. Return on equity sits at around 7.5%, which is decent for a REIT. And finally, the dividend yield is floating between 5.3 to 5.6%, higher than most fixed deposits, and way less volatile than stocks or crypto. So is Ascendas REIT undervalued? Not exactly. Is it grossly overpriced? Also no. It's trading slightly above book value, but backed by strong assets, consistent rental income, and a history of paying out reliable dividends. It's like paying a little more for kaya toast at your favorite kopitiam, because you know it's good and you trust the uncle flipping the bread. Chapter 6. Dividend History. Reliable, frequent, and fuss-free. When it comes to REITs, let's face it, we Singaporeans really love our dividends. And CapitaLand Ascendas REIT has been a steady performer in this space for over 20 years. Since its listing in 2002, Ascendas has maintained a consistent track record of distributions. While REITs traditionally paid dividends twice a year, Ascendas has increasingly moved toward more frequent payouts, often quarterly in recent years. So yes, unit holders get income multiple times a year, though official reporting still tends to be on a half-yearly or full-year basis. Over the last few years, the annual dividend per unit, or DPU, has been incredibly stable. For financial year 2022, it was 15.798 cents. In 2023, it was 15.116 cents. And for 2024, it's 15.205 cents. That's roughly 15 cents per year, as steady as your MRT train during non-peak hours. And as of now, Ascendas's dividend yield is around 5.4%. Let's put that in context. Fixed deposits? Around 2 to 3% if you're lucky. Rental property? Maybe 2 to 3% after loan interest and maintenance. Stocks or crypto? Well, those could fly, or flop. With Ascendas REIT, you get regular income, liquidity, you can buy or sell anytime on SGX, and most importantly, peace of mind. You're investing in a portfolio of income-producing assets backed by a strong sponsor. So while it won't 10 times your capital overnight, it's the kind of investment that quietly pays you while you go about life. And honestly, who doesn't love that? Chapter 7. What's ahead for Ascendas REIT? So what's next for CapitaLand Ascendas REIT? Are they just sitting back and collecting rent? Not quite. This REIT is still actively growing and refreshing its portfolio. In the U.S., they're building a new logistics center in Somerville, set to complete by end of 2025, positioning themselves to ride the demand for smarter, tech-enabled warehousing. Closer to home in Singapore, they've just completed the redevelopment of Janeo at 1 Science Park Drive in March 2025. And leasing momentum is strong. About 76% is already committed, with another 19% in advanced negotiations. That's 95% leasing progress, which means the property is nearly fully spoken for not long after completion. Impressive. But it's not just about shiny new buildings. Ascendas REIT is also making sure its portfolio stays relevant. Around 80% of its properties are green certified, which isn't just good for the environment. It's increasingly demanded by global tenants who care about sustainability. Their focus? Future-proof sectors like logistics, biomedical, tech, and yes, data centers, the physical homes of your cloud storage and late-night streaming. Now let's compare this to one of its peers, Mapletree Pan-Asia Commercial Trust, or MPACT. While MPACT has solid commercial assets, it's faced challenges, especially with Festival Walk in Hong Kong, where footfall and retail spending have been under pressure. The Hong Kong exposure adds some risk and volatility. Meanwhile, Ascendas? It's been steady, diversified, and defensive. Think of it like your reliable uncle. He might not shout, but every quarter he quietly shows up with Kopi money. More diversified globally, focused on resilient tenant sectors, and less exposed to office or retail volatility. So while Ascendas may not be the flashiest REIT out there, it's one of the most dependable. And in today's uncertain climate, that's something income investors can truly appreciate. Chapter 8. Fed drama and why it matters to your dividends. Let's take a quick detour to Washington, D.C. Now I know what you're thinking. What does some guy in a suit in the U.S. have to do with my Singapore REIT? Well, more than you might expect. You see, the U.S. Federal Reserve, also known as the Fed, sets interest rate policies that affect global borrowing costs. And that means yes, what Jerome Powell says can echo all the way to your REIT returns in Topaio. Lately, the Fed has been split. Some officials want to start cutting rates to support the economy. Others are saying, let's not be too hasty. Most economists now think the first rate cut will likely happen in September 2025, not July. And then there's Trump. In true Trump fashion, he stormed in with some dramatic flair, calling Powell a stubborn mule and publicly urging him to resign. Why? Because Trump believes Powell isn't cutting rates fast enough, and that it's hurting the economy. Yes, that's an actual news headline, not a scene from The Apprentice. But here's why this all matters to us investors. Why do Fed rates matter to REITs? When interest rates go up, REITs pay more to borrow, since they usually finance properties with debt. Investors also demand higher yields elsewhere, so REIT prices fall to stay competitive. And DPU, dividend per unit, might get squeezed a little. When rates go down, REITs can refinance cheaper. Their DPU looks more attractive than fixed deposits again. And REIT prices tend to rebound. So yes, a Fed rate cut could boost REITs across the board. It's no guarantee, but it's why REIT investors in Singapore are watching Powell's every word, sometimes more closely than the latest Korean drama plot twist. And for a stable REIT like Ascendas, with strong fundamentals and steady income, lower rates could be the tailwind that makes its dividend yield even more appealing, without changing anything else. So hang tight, because what the Fed decides in the coming months could make your REITs a whole lot sweeter. Chapter 9. So, should you buy Ascendas REIT? We've looked at the properties. We've crunched the numbers. We've even talked about how Jerome Powell and the Fed's decisions could shake up REIT prices around the world. So here comes the big question. Is now a good time to invest in CapitaLand Ascendas REIT? Let's break it down. Here's what we really like. Ascendas REIT offers stable income, backed by a strong sponsor in CapitaLand Investment. It has a diversified global portfolio, but still maintains solid exposure to Singapore, a market known for its real estate stability. Rental reversion has been positive, up 11% recently, and its dividend track record is as reliable as your morning copy. And let's not forget, when interest rates start to fall, as they likely will later this year, REITs like Ascendas could benefit from lower borrowing costs and higher investor interest in stable yields. But of course, there are some things to watch. There's been a slight dip in occupancy in some overseas properties, especially in the US and Australia. It's also not trading at a huge discount. Price to book is slightly above historical average. And while the DPU is stable, it's not exactly growing rapidly. This is a slow burn, not a moonshot. So what's the final verdict? If you're looking for a steady, long-term dividend play to park your CPF-OA, SRS, or just grow your passive income safely, Ascendas REIT is still one of the best income machines in town. Just don't expect it to double in 6 months. This is copy money, not crypto. But it's copy money that shows up on time, quarter after quarter. And in today's market, that kind of consistency is worth a lot. If you found this video helpful, do us and fellow Singaporeans a favor. Hit that like button so more people can discover this, subscribe to Wealth for You, and don't forget to press the notification bell so you never miss a new episode. Got a REIT or stock you want us to break down next? Drop it in the comments. I read every one. Until next time, stay invested, stay informed, and may your dividends flow like Taiping on a hot day.